Welcome to the Deep Dive. Today, we're plunging headfirst into what feels like, well, a truly pivotal moment in the financial markets. We're looking at real-time observations from July 2025.
Yeah, things feel a bit different.
Definitely. Something genuinely unusual seems to be brewing, especially with that recent White House announcement. The market seemed, incredibly eager to react to that.
They certainly did.
So our mission today is really to uncover the why behind these shifts. We'll dissect key market movements, trading strategies, and these powerful underlying forces that are, well, literally rewriting the rules of growth, it seems. We've pulled from a wide breadth of sources to major index movements, individual company outlooks, even crypto and forex, just to try and paint a clear picture of this whole evolving landscape for you.
And like you said, we're here to go beyond just the what. Our goal is really to explain why these intricate market dynamics matter to you, providing truly actionable insights.
Right.
We'll walk through concepts like precise stop-loss adjustments, understanding how large institutions target those liquidity pools, and recognizing when the market gets sort of pinned in place, really give you that holistic view.
Okay, let's unpack this then. Starting with the major indices and some of the precise positioning strategies we're seeing.
Sounds good.
On the S&P 500 futures, ES as it's often called, we've observed active long positions around, 62.45?
That's the level, yeah. Around 6245.
And this isn't just a number, right? It's a critical point where a lot of traders are betting on more gains.
Exactly.
But it's been a pretty precarious situation lately, hasn't it? The market came very, very close to stopping traders out, only to immediately just snap back.
It did. It snapped back hard.
Makes you wonder what's truly driving those swift reversals.
Well, that snapback almost immediately suggests that a liquidity pool under those positions might be under attack.
Okay, explain that a bit more. A liquidity pool under attack.
Yeah, so imagine a liquidity pool as just a dense concentration of buy orders sitting at a specific price level. When it's under attack, it means large players are actively trying to push the price down just enough to trigger those buy orders.
Ah, okay. To scoop up shares or just cause movement?
Often to profit from the volatility that comes after, yeah. And that's precisely why we're seeing these strategic adjustments, like traders moving their stop losses from, say, 6199 down to 6185.
Right, getting out of the immediate firing line.
Exactly. The why here is crucial. You place the stop loss slightly below a known support zone, not precisely within it. It helps reduce your risk from those false breakdowns, those quick dips designed just to trip up traders.
That makes sense. That interplay between liquidity and, well, market psychology is fascinating. It leads us straight to the NASDAQ, where we're seeing another really intriguing pattern emerge. It's almost like the market is holding its breath.
It really is.
It looks like there's this consistent ceiling right at the July 3rd candle high. The price just hasn't closed above that level on the daily candle at all since then. That really points to a specific market phenomenon, doesn't it?
It absolutely does. That phenomenon is what we call pinning action.
Pinning action, okay.
Yeah, imagine the market price is like a ball, right? And it's suddenly caught between two strong, sort of invisible forces. Maybe it's large options contracts expiring at a certain price, or it could be major institutions trying to keep the price within a specific range for hedging purposes.
So it's just stuck.
It's effectively pinned in place, yeah. Not really wanting to go down, but not wanting to go up either. It's just consolidating sideways.
Okay.
And this creates this kind of spring-like tension. This consolidation is absolutely critical for predicting big breakouts once that pressure is finally released.
And what's the trigger? What releases the pressure?
Well, the single event that we really expect to make this market truly expand, that's the start of earnings season, which kicks off tomorrow.
Ah, okay. So beyond the exact numbers and these technical patterns, the core insight here seems to be just how profound the impact of institutional behavior is, this liquidity hunt and pinning action on what look like random market moves.
Definitely.
It reminds us that markets aren't just reacting to news headlines, but also very much to how the big players are positioned. So what does this all mean for what's coming next? Earnings season kicks off, and Netflix is front and center. Kind of a bellwether, right?
Indeed. Netflix is definitely one to watch. It's been undergoing a pullback ever since the month opened for July, actually. And their earnings report is tomorrow, Thursday, after the close.
Okay.
Now, despite this down month, the setup for Netflix is actually quite bullish if you look a bit wider, especially when you look at the past quarterly candle that was extremely powerful, closed right at the highs. And that's where the teaching of monthly and quarterly opens comes in. It's a concept where any drawdown you get from the monthly open is generally supposed to be the downside back, kind of the recoil of the entire quarter before it starts expanding higher again.
I see. So the pullback is almost expected within the larger trend.
Exactly. And Netflix, well, it has this daunting habit of gapping up or gapping down quite significantly on earnings, often moving 5 or even 7% on the day itself.
Wow.
And in past instances, we've seen it move up to 15%, which is significant because, a 15% move in Netflix can translate to a full 1% move in the NASDAQ index just due to its sizable weighting.
Right. It carries a lot of weight.
It really does. So from a technical setup, Netflix is sitting very nicely right at a support zone. It's essentially just waiting for that earnings event to provide some kind of a reaction before it can really start moving again. It truly sets up the tone for the entire earnings season.
That's fascinating how one company's report can be such a major tone setter for the whole market. It makes you think about how interconnected these seemingly individual reports really are.
Absolutely.
So beyond the traditional markets, we know many of you are asking about crypto. Let's dive into Ethereum and Bitcoin for a bit.
Okay, crypto. For Ethereum, the larger time frame outlook is, well, unequivocally bullish. No doubt about that long term.
But I sense a buzz.
But yeah, there's a side of caution right now. We're approaching a region on the chart where you don't necessarily want to be holding on to your long positions with a death grip. It's probably a good time to be thinking about taking some profits.
Why is that?
Well, this is what we call an untested resistance zone. It's basically a price level that the market hasn't managed to sustain above for the past 2 years. It keeps hitting it and falling back.
Okay, so a major hurdle.
A major hurdle, exactly. Now, will it eventually break? Yes, I think likely in about maybe 4 or 5 months as the market generally heads towards new all-time highs. But caution is really key when you're entering an untested resistance zone like this, especially after a large drawdown and then a retest.
So if a pullback does occur, maybe from this resistance, what are the actionable buy regions someone might consider? Where could you look to get back in?
Good question. If a pullback does happen, 2,800 is probably the first region I'd look at to buy for a spot long position. And if it goes deeper, 2,600 would be the second key level.
Okay, 2,800 and 2,600.
Yeah. The overall structure, from the lows around 1,300 up to this recent high near 3,200, it's a very bullish structure fundamentally. It really sets the tone for a further rally, potentially to $5,000 later in the year, maybe October, November timeframe.
And what about the big one, Bitcoin?
Bitcoin is also higher time frame bullish, definitely. It's important, though, not to think that just because we expect a pullback, it implies bearishness. It doesn't.
Pullbacks are healthy in an uptrend.
Exactly. It simply means we're likely to see a near-term top form, often signaled by something like a broken consolidation low on a shorter time frame. This is how verticality, these sharp moves up, often unfolds, A straight line up, then a pullback to establish a next higher low, then another move higher again.
Makes sense.
And Bitcoin has seen some impressive gains recently. We had that, 10% jump within just a week, and it's rallied about 25% from its recent bottom.
Pretty strong move.
Very strong. So those resistance zones that were broken on the way up, they now act as very, very strong support zones on the way down. They become ideal potential long entry points if the market does pull back.
Okay. So even in the, let's say, sometimes volatile world of crypto, these key technical levels offer surprisingly clear guidance, don't they?
They really do. Structure is structure.
All right, let's pivot now to forex, starting with GBP/USD, the British pound, versus the US dollar, and then maybe connect it to the broader implications for the dollar index itself.
Okay. So with GBP/USD, we actually exited our long positions earlier in the week.
Oh, interesting. Why?
Primarily because the daily candles started closing below key support resistance levels, what we call SR levels. And that's really the beauty of using clear SR levels. They allow for extremely precise risk-reward ratios. The moment the market didn't respect that level, well, there was simply no reason to stay in the trade.
Got it. Cut the risk.
Exactly. And this action, particularly the taking out of a specific low on GBP/USD, represents the first ever market structure shift in its entire uptrend since January 2025.
The first time since January.
The first time. Every single pullback until now has defended the previous higher low. This one didn't. That's quite a profound change in character for the currency pair.
So what does that actually mean? What are the implications of that kind of shift?
Well, it means you should probably be actively looking to short GBP/USD now if a bounce does happen. There's a specific resistance zone higher up that looks like a potential short entry region.
Okay, looking for shorts on bounces.
Yes. And this shift also strongly suggests that the dollar index, the DXY, may have found a bottom, or at the very least, it could be going through a significant counter-trend reversal to the upside.
Ah, the correlation.
Exactly.
Okay.
There's a very distinct pattern forming in the dollar index involving an inside monthly candle. That's basically a month where all the price action stays entirely within the high and low range of the previous month.
Right.
If this current month closes inside the lows of the previous inside monthly candle, it sounds technical, but it's a clear signal that would trigger a long opportunity for the dollar, targeting 102 first, then potentially 104.
Okay. And you mentioned connecting this to a bigger picture.
Yes. Here's a crucial insight, something that might explain why the dollar index has been falling in recent months. It's something you might not hear much about on mainstream financial news. It ties into what some call the repatriation trade.
Repatriation trade. Okay, break that down for us.
Exactly. So, picture this. Large foreign entities, think European, Australian, Japanese central banks, big pension funds, they were essentially calling their money home from U.S. equities, pulling capital out.
Why were they doing that?
It seems largely due to concerns about shifts in U.S. foreign policy. For example, talk about the U.S. potentially wanting to exit certain parts of the world order, or maybe questions around security assurances to places like Europe and Ukraine.
Ah, geopolitical concerns driving capital flows.
Precisely. And this capital, when pulled from U.S. stocks, was being converted from U.S. dollars into euros or other currencies, often to fund their own domestic security spending. That selling pressure weakened the dollar.
That makes a lot of sense.
Yes.
So connecting this to the bigger picture, if the dollar is indeed bottoming out now and starting to go higher, what does that mean for other asset classes?
Well, the typical correlation suggests that if the dollar is bottoming out and going higher, then U.S. indices will likely also go higher. And importantly, they would probably outperform other global asset classes like German stocks or the Nikkei in Japan.
So U.S. markets lead the way.
Potentially, yes. While other global indices might rise too, it likely won't be with the same kind of breadth or strength as we might see in the U.S. indices if the dollar is strengthening.
This raises a really important question then. What exactly is driving this potential strength, especially in U.S. indices? It feels like it's much more than just monetary policy or even these geopolitical shifts you just mentioned.
You're absolutely right. And the answer, I think, lies squarely in the growth sector for U.S. technology, which is primarily the NASDAQ.
The tech engine.
It is. When you look at which companies have truly outperformed lately, it's the big names. Microsoft, NVIDIA, Meta, Google. You compare that to a non-tech giant like Costco, for instance, you just don't see it performing in the same stratosphere.
Right.
The money is clearly flowing into these new technologies that are fundamentally driving real growth. Take NVIDIA, for example. Its revenue is it's going off the roof. It's parabolic.
I keep hearing about NVIDIA.
And for good reason. Crucially, monetary policy, interest rates, Fed decisions, it does not dictate what a company's revenue is going to do on this scale. It's also largely independent of geopolitical risk, surprisingly.
Why is that? Why is NVIDIA so insulated?
Because NVIDIA is creating the infrastructure for the AI revolution. They're building new AI data centers, developing specific chips, like those using their CUDA network, which power the most powerful computing chips on the planet right now. The demand for these is simply insatiable.
And this demand, it's just staggering, isn't it? Can you give us an example of just how vast this demand for these chips really is?
Absolutely. Let's just take one example. xAI, Elon Musk's AI company. They accumulated 250,000 high-end GPUs from NVIDIA just to train their Grok model. 250,000.
That's just for one model's training.
Wow. And that's not the end of it. They apparently plan to scale from 250,000 to a staggering 1 million GPUs by December 2025. Just that expansion from that one company adds something like $5 billion worth of income to NVIDIA from xAI alone.
That's incredible.
And it's not just xAI, right?
Yeah.
All the other Magnificent Seven companies, Microsoft, Tesla, Amazon, Google, Meta, they are racking up billions and billions of dollars purchasing these high-performing GPUs from NVIDIA to build their own data centers and train their own new AI models.
So it's an arms race, essentially, for AI compute power.
It really is. And AI itself is proving to be a massive productivity booster. You know, Grok, for example, can save analysts immense amounts of time on market analysis research.
Right.
Now, this also creates a significant concentration risk, or maybe an opportunity, depending on how you look at it, in the broader market. NVIDIA now has about a what, 13% weighting in the S&P 500 and maybe 14% in the Nasdaq Q?
Huge influence.
Massive. It means its earnings performance directly impacts the direction of those major indices. Microsoft also benefits hugely given its heavy investment in OpenAI and ChatGPT and its own AI initiatives, which also rely on these powerful GPUs.
So the core message here seems to be,
The core message is this. We are smack in the middle of this new tech revolution, driven by AI. And with company revenues, especially NVIDIA's, increasing at such an incredible pace, traditional monetary policy is simply not going to matter as much for a while.
for how long do you think?
Potentially for at least another 6 to 8 months, maybe longer. The real focus, the event everyone should be watching, is NVIDIA's earnings report.
So what we've really uncovered today is almost a new market paradigm, isn't it? Where these groundbreaking technological advancements like AI are creating such explosive revenue growth that they can potentially override even traditional macroeconomic factors like interest rates, at least for the foreseeable future.
That's exactly it. It's a fundamental shift in how we need to think about market drivers right now.
That's a really profound takeaway. It makes you reevaluate everything you thought you knew about market catalysts. So, okay, let's look at some individual company outlooks and maybe broader market patterns through this new AI lens.
Sounds good. Let's start with Apple. For Apple, my forecast is that its current resistance level is pretty much toast.
Toast. Confident.
Yeah, I think earnings should be the catalyst needed for smooth sailing up to around the 225 level. There's an open gap on the chart there that looks like a magnet.
Okay.
But what's perhaps equally interesting with Apple and the broader market is a potential seasonal dynamic that might be coming up soon.
Seasonality. August and September often get a bit tricky, right? Tell us about that historical caution.
Yes, there's definitely a seasonality aspect we need to consider. Historically, the Nasdaq Q in particular tends to go through something like a 10 to 15% pullback sometime in September, usually finds a bottom in October or November, and then rallies into March of the next year.
So caution is warranted for the next couple of months.
Based purely on history, yes.
Okay.
Some long-term investors might even choose to avoid adding significant new positions in August and September altogether, just based on that pattern. However,
There was a however.
there is. It's really important to counter that historical tendency with the current market structure. And right now, it's very much bullish. It feels eerily similar, actually, to how markets behaved after the post-COVID highs were made.
How so?
Well, we saw new all-time highs, then some sideways consolidation, and then further expansion. Even that sharp 23% drop we saw not too long ago was very quickly retraced within just 3 months. That shows underlying strength.
Okay.
And this brings us to a key pattern we often observe on the longer time frames, something sometimes called a quarterly bullish order block.
Quarterly bullish order block. What's that?
Think of it like a deeply ingrained historical buying zone on the quarterly chart, a price level where, over years, smart money has consistently stepped in and pushed prices significantly higher. When this pattern is confirmed, the historical data is really compelling.
How compelling.
The data shows that the next 3-month period, the next quarterly candle, is almost always bullish. It provides an average return of something like 12 to 13%. And remarkably, this pattern hasn't seen a failure, hasn't been breached in over 20 years of data.
20 years. That's significant.
It is. So this strongly implies higher prices potentially for the next 2 to 3 quarters based on the current structure. Which means if a pullback does occur in August or September, given this underlying bullish structure, it should probably be seen as a gift, a buying opportunity to go long on things like QQQ or SPY at key support levels.
So seasonality suggests caution, but the current structure screams underlying strength and suggests buying dips. Fascinating contrast.
It is. Now, quickly looking at Google, there's a massive gap up on its chart from a while back, and it shows inherent buying pressure because it hasn't really reacted much to recent NASDAQ Q down candles. It seems poised to catch up, probably benefiting from this broader tech strength we've been talking about.
Makes sense.
And just to re-emphasize NVIDIA's dominance again, it's clearly in an expansionary market phase right now. If you look at, say, 3-day candles, they aren't even violating the lows of the previous candles. It's just stair-stepping higher. NVIDIA truly is the source driving the NASDAQ Q higher at the moment.
So it really boils down to,
If Microsoft and NVIDIA are going higher, the NASDAQ Q will go higher. It's almost that simple right now due to their sheer weight and momentum.
and this circles back perfectly to that crucial question we touched on earlier. If the core technology driving NVIDIA is so foundational, so revolutionary, does anything else, like monetary policy tweaks or even geopolitical conflicts, truly matter for its trajectory in the near term?
And as we discussed, for NVIDIA specifically, the answer seems to be almost always no, at least for now. It's because of that inherent, almost insatiable demand for its AI technology. It's a fundamental technological shift creating its own demand cycle, not something easily swayed by traditional economic levers or geopolitical noise.
Okay. Now, you mentioned Tesla earlier, too. What's the outlook there?
Ah, yes, Tesla. It's currently showing a pattern, maybe a double inside quarterly kind of failure pattern is one way to describe it. It indicates some consolidation and indecision still in its early phase.
But you hinted at something bigger.
Yes, the potential juggernaut scenario here, the real game changer, would be a shareholder vote to actually incorporate XAI into Tesla. Making XAI a subsidiary, much like OpenAI, is linked to Microsoft.
Wow, merging the two.
If that happens, Tesla's revenue is just going to go off the roof. Because, as we said, XAI's demand for GPUs and its potential applications are enormous. It would create an entirely new, massive revenue stream for Tesla overnight.
And the stock price.
This could easily propel Tesla towards the $1,000 mark, perhaps even beyond. And the concrete AI integration is already happening, right? We're seeing Grok being integrated into Tesla's mainframe, into the cars themselves, providing an AI assistant while driving.
That's a huge differentiator.
It's a massive edge over literally every other car company on the planet right now. So the advice would be you probably want to be positioned ahead of this potential trend. Think about where you might want to buy.
Any specific levels?
Well, if their upcoming earnings happen to disappoint for some reason and maybe cause a gap down in the stock price, a target buy region down around $270 would look very attractive for initiating or adding to a position.
This deep dive has really underscored this new paradigm emerging in the financial markets. It's so clearly driven by AI technology now. It truly feels like a tectonic shift in what actually matters for market performance.
It absolutely is the new narrative in the market. It really reminds me of the blockchain boom back in, 2017?
Yeah, I remember that.
Any company that even just mentioned the word blockchain in their earnings report would see their stock jump 100, 200%, right?
Mm-hmm.
It's kind of the same dynamic with AI right now, but arguably with even more fundamental real demand behind it.
Right. This time it feels more tangible.
Exactly. We're seeing real, measurable demand demonstrably through companies like NVIDIA and the plans of XAI. They're creating revenue streams that are, like we said, quite literally parabolic. It's an incredibly exciting and potentially disruptive time to be watching the markets.
So here's the final thought to leave you with. Given this profound and seemingly almost unshakable impact of AI on the market, especially on these key companies like NVIDIA and Microsoft, how will you adapt your own understanding of market drivers, knowing that those traditional factors like monetary policy may genuinely take a back seat for the foreseeable future?
Thank you for joining us on this deep dive. We really encourage you to continue exploring this incredibly exciting and rapidly evolving space.